Welcome to October's review of the True Potential portfolios. My name is Barney Hawkins. I'm the investment director here at True Potential, and I'm going to spend the next few minutes talking about our flagship investment product, the True Potential portfolio range. We'll start by discussing the performance of the portfolios. We'll then look at the key themes being pursued by our fund manager partners, and finally cover the changes that have been made over the month. During September, the portfolios fell slightly, giving back some of the strong returns already accumulated this year. A significant influence for market returns has been the impact of the strong currency. When returns from overseas assets are translated back into sterling, they face a headwind if the value of the pound has increased. Looking under the bonnet at how the underlying funds have performed, we've seen negative returns from the True Potential SEI range. In the defensive and cautious portfolios, SEI has exposure to a strategy called Global Managed Volatility. This strategy targets high-quality companies that exhibit low volatility and pay above-average dividends. However, it can be susceptible to fears of higher interest rates, and with Mark Carney, Governor of the Bank of England, giving his clearest indication yet that monetary policy is likely to be tightened, it would appear that, at least in the short term, some investors have been taking profits. On a brighter note, there have been good returns from the True Potential Goldman Sachs Income Builder Fund. Our fund is fully hedged into sterling, which has helped mitigate the effects of a rising pound. The True Potential Schroder Fund has also performed well relative to our other managers, their high cash balance and an underweight bond holding helping to protect capital. In general, our managers continue to be reasonably constructive with regard to market conditions. Those managers who invest in direct equities, say Threadneedle, Close Brothers and Goldman Sachs, remain fairly sanguine about markets and are still able to find attractive opportunities despite valuations generally being high. In terms of trading over the month, there were several changes made within the portfolios. We continued with the theme of favouring stock pickers and those who manage their sterling exposure to help mitigate negative currency moves. As we progress through the market cycle, and with most asset prices having risen, stock selection becomes an increasingly important way of identifying opportunities. So in the defensive, cautious, balanced and growth portfolios, allocations have been increased to Close Brothers, 7IM and Goldman Sachs at the expense of SEI and Allianz. In the lower risk portfolios, 7IM offers a more defensive tilt should bond yields nudge up and sterling appreciate, while the Goldman Sachs Dynamic Fund incorporates a variety of alternative strategies, helping the portfolios diversify away from interest rate sensitive bonds and equities. Turning to the plus portfolios, the changes which have taken place reflect a requirement to trim back on risk. Weightings to Close Brothers Balanced and Schroders Cautious have been increased as they are lower risk compared to 7IM Aggressive and SEI Aggressive, which have been reduced. Allocations across the income portfolios remain unchanged.